Hi there and welcome to this week's episode of Canadian Profits TV. This is Dave Dubeau, and this week, because we're in the middle of summer, we're just going to have a very short episode. And basically I just want to give you a real estate tip about something that's kind of happened to me a few times and to one of my students recently, and that's coming across an existing rent-own deal that you can potentially take over, and my cautions for it. Stay tuned. All right, so for this week's real estate tip, I want to talk about coming across existing rent-to-own deals and the opportunity to take them over. So a couple of months ago, one of these potential deals came across my table. Looked very interesting. We had a very motivated couple apply to us for doing a rent-to-own deal. They were already in a rent-to-own deal, and they needed to extend it a little bit, and the home seller didn't want to extend the deal, so they wanted to sell the property right away. So they wanted to see if we could get involved and buy the property for them and continue the rent-to-own deal. I was very, very cautious at the beginning of this, and thank goodness I was. I ended up talking with the existing homeowners. Turned out they were friends with they're now ex-friends with their tenant buyers, and that the tenant buyers hadn't really done anything that they had committed to at the beginning of their deal. They had structured the deal incorrectly. It was just a complete mess. So when I saw that, and I saw that the tenant buyers were actually lying to me on their application form, I just threw that deal right out the window. Now, more recently, I just had one of our rent-own students and a Creative Profits Club member call me up about a prospective rent-own deal that they've had come across their desk as well, and that is where the tenant buyer, the tenants have an agreement with the home buyer, the home seller. They've been going along for about a year and a half, and just a certain percentage of the rent is supposed to apply towards a down payment. But now the home seller wants to sell. The renters aren't in the position just yet to buy it, so they're asking my student if they will buy the house for them and rent-own it to them for the next 2 to 3 years while they get qualified. So on the surface, it looks pretty good, but my caution was to be careful for several different things. First thing you have to be really, really cautious about is how much is the property seller asking for their house. This is a for sale by owner, a FSBO property. Are they completely out to lunch with how much they're asking, or are they asking for fair market value for the property? So that's number one. You can't overpay for it. And in fact, if you're doing a FSBO deal, you should actually try and get the property a little bit lower, because there aren't any real estate realtor fees to be and commissions to take into account. So you should get it a little bit less for that. Next thing is, how were the legal documents structured in the first place for the initial rent-own deal? In this case, I don't think there were any. So how are you going to be able to recognize those rental credits from the previous deal with your new deal? My suggestion in this case was to do a cash back at closing. So let's say, for sake of numbers, the property's $300,000, the rental credits are $6,000. Then the way you would structure that is buy the property for $300,000, if that's what it's worth, and get $6,000 back, cash back at closing, to apply towards the option fee for your new deal. But the most important thing that I told them to be very, very cautious about was to make sure that they're on the same page with their tenant buyer. Why is that so important? Well, right now, the tenant buyer is doing the rent-to-own deal with the original homeowner. We don't know how much the original homeowner paid for that property, how long ago they purchased the property, how much equity they have in the property, all that kind of stuff. My assumption is that they've owned the property for a significant amount of time, they have quite a bit of equity in it, and chances are their mortgage payments are reasonably low. Why is that important? Because it affects probably how much rent they were charging the rent-own client. So for example, this kind of property, if they were charging, let's say, $1,600 a month rent, and when we turn around and we do the deal, and we have to, because of the price of the property, we have to charge $2,000 or $2,200 a month rent, is that going to be a deal breaker for the tenant buyer? My thoughts are probably it will be. So that's a very important conversation that you have to have up front with your potential tenant buyer, is just showing them, giving them a reality check on how much more rent they're going to have to pay and how the deals are going to work. So that's the cautionary tale about taking over existing rent-to-own deals. All right, I hope you have a great week this week. I just want to let you know that Steph and Arnio and myself are going to be starting our new program, the Buy, Fix, and Sell Cash on Demand system. You can find out all about that at buyfixsellsystem.com. Again, buyfixsellsystem.com. That's going to be starting right away. And if you're interested in doing flips, if you're interested in doing 90-day turnaround deals, buy, fixing, and selling, and making a very quick $20,000, $30,000, $40,000 in profit, you'll definitely want to be part of that program. Have a great week. Talk to you next week. Bye-bye.